Hello traders, you're welcome to this video. In this particular video, we are going to be discussing bearish reversal. So stay tuned because we are going to be identifying different methods in which you can use to know that a bearish move is about to start. Basically, to spot a bearish reversal or a potential bearish reversal, you need to be aware of key indicators and chart patterns that signal a shift from an uptrend to a downtrend. Now, some of the most reliable patterns are candlestick patterns, chart patterns, technical indicators, volume analysis, and divergence. But we're going to be looking at each of them one after the other, right? Briefly. So as for candlestick patterns, some of the most common candlestick patterns for bearish reversal are shooting star, bearish engulfing, evening star, but we're going to be looking for examples now of each of these bearish reversal patterns. Okay, we're going to be looking at examples of each of them, right? Okay, now as for the shooting star is a candlestick with a small body and a long upper wick. As we can see here, I just use this vertical line to identify the place that I want to display, that I want to zoom into, right? So we can see that the shooting star it has a small body, as we can see here, and a long upper wick. It appears after an uptrend, like you can see, there was an uptrend here, an upward movement, right? It usually appears after an upward movement, and it indicates that buying momentum is coming to an end, and sellers are starting to gain control. So the shooting star is one of the candlestick patterns that is used to show a bearish reversal. Right after the shooting star, you can decide to enter your sell trade. Right after the shooting star, set your stop loss above the shooting star, and you can target the next support level for your take profit. You can also use other indicators for additional confirmations. Now, another candlestick pattern is the bearish engulfing. Although we have already discussed the bearish engulfing in a previous video, but we are just going to be looking for an example of a bearish engulfing. Okay, I found one example right here. Okay, now the bearish engulfing occurs when a larger red candlestick, like we can see here, a larger red candlestick fully engulfs the previous blue or green, depending on your color. But basically, a large sell candle fully engulfs the previous buy candle, or the bear candle. A large bear candle engulfs the previous bull candle, as you can see here. Now it suggests a strong selling pressure and a possible reversal. Now this engulfing pattern can occur in a sell trend after a pullback, or it can occur after a buy trend, indicating the start of a sell trend. So in this particular scenario, the bearish engulfing formed in a bearish trend after a pullback. You can see that after price pullback here, the engulfing formed, showing a continuation in the bear trend. Okay, now another candlestick pattern, a common candlestick pattern used, is the evening star. The evening star, although it's not always very common, but you can be able to find it on your charts when it shows up. So it is a pattern that consists of, is a three candle formation pattern, right? Formation of three candles, okay? The first candle is going to be a bullish candle. Okay, I think I found an evening star around here. Okay, you can see it's the pattern is formed from three candles, right? It's the three candles that make up the pattern. And the first candle has to be a bullish candle, as we can see here. Then the second candle is a small indecisive candle, just like we can see here, a small indecisive candle, or it could be a doji, right? And then the third candle is a large bearish candle, like we can see here. So basically, this is an evening star that we have around here. The pattern signals a reversal at the top of an uptrend. So we can see that this was an uptrend and the evening star formed right after the uptrend, indicating bearish momentum. So we would have decided to sell right after the evening star formed and set our stop loss above the evening star or above the resistance zone entirely, perhaps around here, but setting it above the evening star is also a good spot to sell, to set stop loss, and then our take profit could be at the nearest support zone. Now, those are the three common candlestick patterns for bearish reversals. Although those are not all, there are in terms of candlestick patterns for bearish reversal, but like these are three of the most common for bearish reversals. Right now, chart patterns. The chart patterns are another way that traders use to spot bearish reversals. Chart patterns. Now, one of the chart patterns usually used is the head and shoulders pattern. The head and shoulders pattern is a classic reversal pattern where the price creates three peaks: a higher peak, the head, between two smaller peaks, which are the shoulders. Now, in this example, we can see a head and shoulder pattern form right about here because we have one peak here, second peak here, and the third peak here, right? Now, the first peak is usually smaller or shorter in terms of length than, or lower in terms of height, it's usually lower than the second peak. The second peak is usually the highest, right? As you can see, the peak of the middle is higher than the peak here and the peak here, right? So the middle peak represents the head, while the two other peaks are the other shoulders. Now, when the neckline is the support somewhere below the around the this zone, yeah, the zone that is right under the peaks, right under these upward curves or these downward curves. These curves, the first curve, the second curve, and the third curve. So the neckline is usually just at the bottom of these curves, right? Now, when there is a breakout, when there is a breakout from that neckline, then it indicates a bearish reversal. But if price fails to break out of the neckline, then likely that price will go upward. Like in this scenario, you can see that the price did not break out of the neckline. This is just a zone. It's just a zone. You can see that price did not break out of the neckline. This is the neckline. Price should have broken out perhaps significantly. Then we will know that a bearish reversal is about to begin. But as price did not break out, the price had to continue going upwards. So a breakout from the neckline downwards indicates a bearish reversal, right? Now, another chart pattern usually used for bearish reversals is the double top pattern, right? The double top pattern. Now, the double top pattern is, as the name implies, it's when price hits the same resistance level twice. And we can see that there was a resistance level here, right? There was a resistance level here, and we can see that price hits this resistance level twice. In fact, it was even three times. It had hit here before and hit it again and hit it again. But basically, this is also a double top pattern. So, if price fails to break that resistance, it usually leads to a bearish move. As you can see that as price fails to break out of this resistance, you can see that the price of the asset sold. See that the price of the asset sold. So double top also indicates bearish reversal. Now another chart pattern, but before we go to the third chart pattern, in a in a double top scenario, right after the second top forms, you can decide to wait for a bearish candle before entering your sell. Perhaps something like this, as a bearish candle with a strong momentum. So would have considered entering a sell somewhere around here, and your stop loss should be above that resistance. above the resistance, right? And your take profit can be at the next support level, which would have been somewhere around here, right? You can see this was a support level. So that would be for take profit. Now, the third chart pattern that traders usually use to spot bearish reversal are rising wedge. A rising wedge. Now, a rising wedge is a narrowing upward channel where price keeps climbing, but the highs and lows converge. Okay, now let's just see if we can spot a rising wedge somewhere. Let's see if we can spot a rising wedge. Let's see if we can spot a rising wedge. Okay, all right, we can see a rising wedge somewhere around here because the price was going up, although the price is climbing up, but we can see that the highs are coming down. It's like forming higher lows and lower highs. Okay, as we can see here, it's the formation of higher lows and lower highs. It's a narrowing upward channel. You can see this is an upward channel, but the prices are converging. As the longer the channel is, the shorter the distance between the boundaries of the channel. So we can see this is a rising wedge. Now this suggests weakening momentum and it often leads to a bearish breakout. It shows that the bullish momentum is getting weak and eventually sometimes it leads to a bearish breakout, as we can see that after a brief consolidation price finally started selling all the way down to this point, right? So this is another pattern that is used for bearish reversal. Sometimes the price might just break out immediately after the rising wedge. After the rising wedge, the price might just break out downwards. But in this particular scenario, the price actually broke out upwards, so we wouldn't have sold because we would have been waiting for price to break downwards. However, this indicates that bullish momentum was getting weak. It's just that later on the bulls prevailed. However, had it been the price had broken downwards, we would have entered a sell right after the bearish breakout. Now, the use of technical indicators is also important when it comes to bearish reversal. Now, some of the technical indicators usually used include the RSI. RSI is like one of the indicators used. The RSI, when RSI is above the 70 or the overbought level, just um, just adjust these back to the default settings. So adjust it back to the default settings. Default settings are 30 and 70. Okay, so when the RSI is above 70, which is overbought territory, and starts to turn down, as we can see here, it signals a bearish reversal. It signals a bearish reversal. Now, um, RSI is not only the indicator that is usually used to signal bearish reversal. The RSI works with momentum. So when the RSI begins to turn downwards inside the overbought territory, it signals that there is a bearish reversal. There is a potential bearish reversal coming up. As we can see that right after this happened, the price sold. Now, another indicator that is usually used is the MACD. The MACD is another indicator that is usually used to confirm bearish reversals. Now, as for the MACD, a bearish crossover where the MACD line crosses below the signal line or below the zero line, as we can see somewhere around here, as the MACD line crossed below, it indicates bearish momentum and a possible bearish reversal. Like we can see here, that right after that crossover happened, you can see that the price of the asset sold, but it sold for a bit. Now, another technical indicator used is the moving averages. Moving averages are another indicator usually used. Okay. Now we're just going to add that to our chart. the crossing of a shorter moving average. Now, most of the times when using the moving average to spot bearish reversal, we usually use two moving averages, right? We use the crossover strategy. Just going to change the color. I'm just going to put this at 21. These are like the common settings for two moving averages, the 9 and the 21. So when you have the shorter period moving average cross over as we can see here, when you have the shorter moving average, the shorter period, in this case the 9 period, cross over the longer period, in this case the 21 period, it usually signals a bearish reversal, the bearish reversal, okay? And it is common, it is usually a common occurrence, like whenever a bearish reversal is about to happen, this is one of like the most common things that happen if you are using moving average for your technical indicator confirmation. This is like a very common scenario of the crossover happening before a bearish move actually prevails, like we can see happening here. Okay, now as for volume analysis, a reversal is often confirmed with increasing volume on the decline. So we're just going to add on to our charts, just going to add on to our charts volume and show volumes, right? So now we can see that, just going to close this now so that we can focus on the volumes now. Okay, so we can see now I've added the volumes to the chart. Now, if an asset reaches a new high, but the volume is declining, it indicates that there is weakening bullish momentum and can hint at a coming bearish reversal. For example, after price got to this high, we can see that the volume began to drop. We can see the shorter lines forming. You can see that the shorter lines were forming, right? And that indicated a losing of bullish momentum. It indicates that bullish momentum was getting weak. So it would have been a point of entry for our sell, right? For our sell, I would have considered setting stop loss right above the swing high. And then as for a take profit, support level would have been a good spot for our take profit. Now, in terms of divergence, we can use indicators like the RSI or the MACD. So I'm just going to add MACD again. We can use either RSI or MACD for divergence. Now, divergence in this situation between price and indicators like RSI or MACD is another key signal. Now, if the price is rising but the indicators are falling, it suggests the strength behind the uptrend is fading, making a reversal more likely. For example, as we can see somewhere around here, we can see that the price was rising, the price was going up, but the MACD was declining, right? You can see the MACD was declining. We have talked about divergence in previous videos. We have talked about that, but let's just give examples about divergence again in this video concerning with respect to bearish reversal. So the MACD in this situation, we can see that the MACD was making lower highs, but we can see that the price of the asset was making higher lows and higher highs. We can see that happening here. So this indicates that the strength behind the uptrend is fading, and you can see eventually the price sold just the after the divergence happened. Right after the divergence happened, you can see that the price sold. Okay, so now that is it for our patterns for spotting bearish reversal. We talked about the candlestick patterns, including shooting star, bearish engulfing, and evening star. We talked about the chart patterns, including head and shoulders, double top, and rising wedge. Let's talk about technical indicators that many traders usually use, including the RSI, the MACD, and the moving averages. And we talked about volume analysis to indicate loss in bullish momentum and possible start of a bearish move. And then finally, we talked about divergence. So mastering these patterns and indicators will help you time entries for short trades or exit from long positions at the right moment. I hope you found this video insightful. Kindly like, and subscribe for more. Cheers, guys, and happy trading.